Howdy there, folks, and welcome into this five-piece here today. 5 videos up for me to react to. I know, it's ridiculous. I know, but it'll all make sense later tonight, okay? It will all make sense later tonight. Let's just put it that way, okay? So first one I want to react to here. Jobless claims total 202,000. We'll react to that little 1-minute clip there. We can't just rely on 5 or 6 names to boost your portfolio. Looking forward to getting into that one. Wall Street Bull, Oppenheimer's John on why the S&P 500 will hit 5,200 by year end. Okay, looking forward to getting into that one. Now's a good time to consider buying the dips in the Magnificent Seven. Looking forward to getting into that one. And then last one up here, Josh Brown. This one's from actually last night. I haven't got to see this one yet. 2024 is the year AI goes from concept to product. So looking forward to getting into that one. Appreciate you guys joining me. As always, thanks so much for being here. Ski Mask with Jeremy. Maybe I'll do it like this for the video. You probably won't be able to hear me. So we're going to go ahead and get into this. And once again, it'll all make sense later tonight. Okay? Alrighty, guys.
And Tully here live at CME HQ with the breaking news of the morning. Initial continuing claims. Initial claims expected to be 215 to 217,000. Well, they come in light. 202,000, 202,000. This is the lightest level going all the way back to the second week in October. And on continuing claims, call it number 5, the 5th consecutive week under 1.9 million. Yes, we had 1.9 million the 3rd week in November. That was the highest level since Nov of 21. But this is 1,855,000. Definitely on the light side. Definitely.
I'm laughing because somebody just walked by the house right now, and I got this like shade open, so you can clearly see in my house right now, and you can clearly see me. And these little kids just walked by with their mom, and they're looking in there, and they're probably like, "Why is that guy in a ski mask in his own house? Like, what is going on in there?"
Below last look at 1,875,000 and 1,855,000 is the lightest level going back to the second week in November of last year. Not that far ago, but as I said, 5th week under 1.9 is significant. There are revisions coming in, not big ones, subtle revisions to the upside. Interest rates moving up on that, and ADP, which was the highest since August, and maybe even more important, across the pond, if you look at inflation in Europe, boy, Germany's specific inflation, which came out at 8 Eastern, was warmer than expected. Prior to that, all the regional areas in Germany's inflation numbers came out hotter than expected. Bund yields hovering at 210. Should they close there, that would be a 3-week high-yield close. We still have more data to come, but the significant aspect of this short year thus far has been interest rates moving higher and yield curve vibrations that seem to be inverting, more on the steepening side.
So it's interesting. Treasuries were moving up there. Let's take a peek at how stocks are doing today, because I'm pretty curious. I haven't got to really look at the market too much on how things are. I would assume stocks are down considering treasuries up, but it looks like it's pretty decent out there, to be honest. I mean, it's a little bit of a mixed bag, but it does look like I'm definitely more green than red today. Let's pull up Big Tech. Big Tech will give us a lot of clues. Big Tech. Wow, it's a mixed bag out there today. Wow. Ooh, I'm going to need to pick up some more Amazon shares soon. Yeah, definitely a mixed bag kind of day out there. What about the indexes in general? Where are we at for those? So Russell's up very slightly. Dow's up very slightly. S&P's down. NASDAQ's down, but very slightly. So kind of a mixed bag day out there here today. So interesting. Alrighty, guys. Next one up here. And by the way, you know, I guess we can say that's positive news. We can't just rely on 5 or 6 names to boost your portfolio.
About what is this dispersion that we're looking at? The reason that Apple is selling off this week is not just on tax loss selling. It's about questions about the fundamentals. And so if you look at each of these stocks and you think about, for instance, as Josh mentioned, advertising. Is this the best way to play advertising from your perspective in this environment? Or are there names outside of Alphabet that you could potentially harness to put in your portfolio for exposure? The other thing that I want to drive home and that you really want to think about is there's a lot of people that are talking about, and we talked about this in our Solving for 20.
I mean, if you're going to play advertising, there's not many direct plays on advertising that are really that appealing. Google's obviously always comes to mind. Meta always comes to mind. Okay, who's third big dog? Amazon. Next one up would be Amazon comes to mind, right? Then you start looking out there, and then it starts to get a little cloudy. You could look at somebody like a Fubo, who should benefit from advertising quite a bit this year, but that's obviously a super small cap stock that not most people are going to be interested in. So there's really only 3 stocks that I think a lot of people are actually interested in as advertising plays. It's Google, Meta, and Amazon, which I own 2 of those. Google, maybe I'll own at some point in time.
Piece, the opportunity to start to buy some of those laggards. Just because you're buying outside of the S&P 500 or buying outside of these 7 names doesn't necessarily imply that large caps are going to underperform here in the U.S. or that even some of these stocks that have performed well last year can't replicate that, a la NVIDIA. Like, you can't say that there's a binary decision here because, Scott, there is money that needs to come off the sidelines. Cash rates are coming down. Short-term yields are coming down. Whether that goes into short-duration bonds or back into some of these underloved parts of the equity market that didn't participate, that's really where we start to kind of fill this gap, if you will, on tax-less selling.
So I'm going to push back against her for just a moment here, because what I've been noticing is at least on the savings account side, from the companies I use, they're still holding very strong right now. Very strong. So I haven't really seen that move down yet. Like, I'm still getting 4.5% or so on savings accounts. So until that breaks and all of a sudden that goes down to the 3s or 2s, I think we're still in one of those moments where people are still kind of looking out there and they're saying, man, I can get 4% plus on savings. Like, I'm going to still continue to take that.
And some of this fundamental dispersion that we're seeing in the Mag 7 right now.
How do you want to...
Yeah, back to you, Shannon. No, I think that what Shannon said is so true. There is still money coming in off the sidelines, and you've got a lot of names to look for. This is a year that we can't just rely on 5 or 6 names to boost your portfolio so you can beat the S&P. You're going to have to work harder, and that means digging into what's working and what isn't going to work for these companies in a slowing environment where there's some growth, but it's not so easy to find it.
Well, and also I want to point out, it's not just 2 days that, these stocks have underperformed. They've performed well on an absolute basis, but it's really been 2.5 months now that the market has broadened its rally. That's a huge positive. And this is what you're saying, Carrie, with do your work and find stocks outside of the Magnificent Seven. Find stocks outside of information technology and communication services. It isn't that hard to do. I'm actually, Scott, I'm really happy that we're not having an economic discussion right now, and I'm not going to mess it up by having one. I'm just going to simply say the data continues to come in that supports a growing economy with slowing inflation. That is an environment in which you can look further afield. You can look in the cyclicals, materials, energy, industrials, and financials.
I would argue, when you say it's not that hard to do, I would say, yeah, actually it is that hard to do. Well, which ones are you going to pick? Which ones you going to pick?
Well, let's pick a sector. Let's pick financials, shall we? That's one that certainly last year didn't have a lot of love.
Materials.
Yeah, I don't think we have time to go through all of them. Let's go through financials. I think there's many easy things that we can say here, whether it's big money center banks that are trading at discounts to their historical multiples of book, or you can look at something, and I don't know if we want to talk about this later, but BlackRock, that's something that this is an easy thesis to understand. If the market's going up, both stocks and bonds, which most of us predict for this year, well, their assets under management are going up and their fees are going up. So what I'm saying here is a synthesis of 2 things. Carrie just said, do your work, look further afield. I completely agree. But I also say in some cases, it isn't that hard. Look at JP Morgan, the creme de la creme. Didn't it set an all-time high just a couple of days ago? It isn't that hard.
Well, if you want to look at more economically sensitive names, you could make the argument that it is a little harder. To your point, right? You said it. So. You said it's going to be harder.
I said it
this year.
I believe it. Yeah.
Don't just look under the hood. You got to take the engine out and look under there. Look under the car, because it's just not that simple when you're worried about what the trajectory of the economy is going to be, when the first cuts are going to happen.
Sure. We don't know any of that.
Yeah, so my opinion here, is it a tough year? Is 2024 a tough year? It's a tough year from the respect of this is going to be, I think, a lot more volatility than 2023. I'm looking out there this year and I see a situation where we've got a crazy election cycle coming that, who knows what's going to happen there. That's something we're going to have to deal with in a few quarters from now, right? We're going to have worries about inflation coming back. We're going to have worries about recession, right? Neither of those might be ever come to fruition, but they're going to be things people worry about from time to time. We got all types of geopolitical stuff all over the place. And so when I look out there this year, I think there's going to be a much more volatile year. I think there's going to be some huge moves up and down throughout the year. And I'm not talking about huge spouts of volatility like we saw during Rona or like we saw during the Great Financial Crisis, for instance. But if you just compare it to maybe the past year that was relatively stable, I think we're going to have some much bigger volatility moves where the VIX is also moving up extremely rapidly, then moving down huge and vice versa. And, you know, all of a sudden the market's coming back strong. Everything looks great. Next moment, everybody's worried. I think that's the sort of market we're going to be dealing with here in 2024, which, by the way, could still end up being a good market. It could still end up being a very good year for the market overall when it's all said and done, when all the dust settles in this situation. But to get there is going to be a drama show.
Exactly.
That's all in the future, but when? So trying to pick a date. Oh, I want to be in the interest rate sensitive stocks by March 15th because we're going to have a cut down. That's ridiculous.
You want to tell me what kind of year Freeport's going to have today?
No.
You want to tell me what kind of year that Caterpillar or Deere are going to have
well,
today?
Deere had a terrible year, so let's hope for the owners that it has a better year than Cat's at an all-time high, right?
You want to tell me what kind of year autos are going to have this year?
I now understand your question.
Yeah.
I now understand your question. So let me rephrase this. Relative, and this is what Kerry was saying, relative to the Magnificent Seven and the Triple Qs last year, which was the easy button, just push the easy button. Yes, Scott, you're absolutely right. This requires all of us doing the homework that we love to do. Opening up the hood, taking apart the engine, it's what we love to do, frankly. But when you do that, and I do that all the time, I do come out and I say, to answer your question directly, Deere? Yeah. Cat? This seems pretty easy, particularly as the cost of capital is coming down. That, you know, stocks like this that generally have more leveraged balance sheets should find that a less of a headwind at the same time, and this is very important, that the economy continues to grow. So there's demand for excavators. There's demand for financing. There's demand for copper. You mentioned Freeport. There's demand for copper. That's the thesis. I feel actually a lot better about that thesis than I have at any point over the last 12 months.
Speaking about copper, man, I almost ran over a bunch of copper. It was in the middle of the highway. I almost ran it over in my Model X earlier this morning. Next one up here, Wall Street Bull. Oppenheimer's John Stolfus on why the S&P 500 is going to be 5,200 by year end.
The year at a level of 5,200. That's more than 10% rise from yesterday's close.
Ooh, look at Ed Yardeni. Yardeni's taking the lead. He went way out there. He said 5,400. It's crazy, man. It's crazy. Like, these are the most bullish people. And even this individual at 5,000, like, man, Wall Street's still not a believer in the market.
Among a handful of Wall Street veterans that also believes the S&P will surge to new highs this year. That would, by definition, we're just a couple percent away, right? Here
Slow
with us
down.
now is John Stolfus, Chief Investment Strategist at Oppenheimer Asset Management. John, good to see you.
Good to be here. Thanks.
So it's interesting, and on one level, you kind of think we can have a pretty good year. On the other hand, when the biggest bull on Wall Street saying we got maybe 10% upside, it suggests overall sentiment maybe is somewhat subdued. How did we come into the year in terms of maybe everybody expecting a soft landing, and which direction of the surprise is going to go?
Well, Mike, I think actually, you know, in December when we put the target in, it indicated 13% upside.
Yep.
But that would still be about half of what the market did last year. We can't help but think a good idea to be conservative in here moving into this year, in the sense that we do expect things are getting better. We're moving towards a normalization, stabilization in interest rates. And with that, the thought is still we've got plenty of volatility out there in terms of uncertainty in geopolitical risk that could actually affect food and energy supply chains in a part of the world that's important. And so a lot of thought there.
You know, we know that a slowdown should happen of some character, right? We had like a 5% GDP quarter, third quarter. It's a question of how much, right? So yesterday we got the job openings and quit rate data, a little bit soft. You see labor market slackening a little bit. Manufacturing still not really bouncing back. And I guess the question is, are we going to be able to stay on that path of slower but not stalling?
We can't help but think that slower but not stalling. We think the Fed has been amazingly sensitive to the effects of it practicing its mandate on the economy. It's part of what we call the Ben Bernanke legacy, and we think Powell is practicing that. When you consider, what is it, something like 11 hikes and 4 pauses or something like that in so far, and no recession. The resilience that's seen in business and the consumer as well as in labor. All of this looks remarkably good, and we think the Fed is, we've said now for over a year, we might actually skirt a recession, and now we're even beginning to think perhaps we do get a soft landing, which would be remarkable.
John, most reports I see believe earnings have to come down, estimates have to come down. How do we get 10% higher? Is it through higher valuations, higher PE multiples, or are you a contrarian when it comes to the direction of earnings?
Hold your horse for just a moment, okay? Let's think about this for a moment. Like, what are the stocks that run the market, right? Well, they're the biggest big techs, right? So let me ask you this. Do these companies' earnings go substantially higher in 24, lower, or stay the same? Start out at the top, Apple. And I'm certainly not the biggest believer in Apple, but if I had to guess one way or another, Apple's EPS will be up nicely in 24 versus 23. Microsoft's basically almost a guarantee. NVIDIA, a guarantee that their earnings will be up substantially year over year. Meta, basically a guarantee. Earnings up substantially year over year. Amazon, basically a guarantee. Earnings up substantially over year. Google, a little bit of a question mark, but probably looking pretty good with Google as well. Who am I missing? Tesla's maybe a little bit more of a wild card in terms of, are their earnings up substantially year over year? I don't know. I think that's a wild card one because that has too many moving parts this year. But you look at all the big techs, all the ones that really matter, all their earnings are going to be up likely substantially this year, right? So, and then you look even past those big techs, and you look into a lot of the, let's call it the top 100 stocks, maybe the NASDAQ, and many of the biggest stocks in the SP 500, and you start to go through those companies like, yeah, this company's earnings are going to be up 5%, 10%, 15%, 20%, 30%, right? So, a lot of companies, you're going to see massive rise in their earnings per share year over year.
Combination of both, Steve, and I think if we just look at third quarter earnings, just think of third quarter that we just got through. When you looked at earnings that originally was expected, consensus was looking, I think, for a 3% decline going into earnings season. Then it kept cutting it, maybe 0.7% decline, and actually had about a 4% gain in earnings. You had only 2 sectors negative. They were double-digit earnings negativity. It was energy and materials. You had, I think it was 5 sectors had double-digit earnings growth, including consumer discretionary, technology, and a number of others.
So do you think the street's too bearish on earnings in general? And what's your forecast? I don't know how it matters to the overall thesis, but we're just about on the cusp of earnings season. What's your expectation?
I think we're looking. I know what we're looking for is we're expecting some positive surprises as we saw last year in both second quarter and third quarter earnings. We think analysts have been remarkably conservative in anticipating how companies are going to perform, and companies have used technology to weather and navigate what would normally be a pretty tough environment when the Fed is in a Fed funds hike cycle.
John, your target implies that the way you get to the math is something like a 21.7 times multiple on this year's earnings. Why do you think the market should be able to sustain that? And I guess what are going to be the components of it? Because you can slice the market up and say parts of it are expensive, parts are cheap.
Yeah, I think, Mike, when we look at this, we have to say that, you look at the generations. Leon Cooperman's generation, stocks are cheap at 12.
Yep.
Boomers think it's between 14 and 16 cheap. X generation, a little bit higher. And when it comes to the millennials and forward, an 18, 19, 20 times multiple looks pretty good. I think what's happening, the news items that say 58% of households now have equities. some exposure to equities. We think that really shows that people are looking. It's not just fear and greed, but need in terms of planning, whether it's for a kid's education, retirement, when Social Security may not be able to deliver what it once delivered in terms of one's retirement. And where are you going to go? Its fixed income is fairly limited, even at 5% versus inflation and after-tax results. But you look at equities, owning a good business historically, past performance, no guarantee of future results, it's usually been a pretty good idea, and equities offers that with prudent diversification.
100%. You got to think, where do I put my money? Where do I put my money? Okay? Like, just logically, you have to think about this. Okay, you can keep it under your mattress, and your value of your money goes down every single day, right? Constantly, the value of money is worth less. $100,000 today is going to be worth far less 10 years from now, 20 years from now, 30 years from now. So then you say, okay, I'll put in a savings account. Okay, savings accounts are yielding high right now based upon any time in the past 20 years, and we're still getting like only 4-something%, right? So that's not usually a very viable option for most folks. Okay, then there's real estate. Well, usually real estate you're going to have to lever into, so then you got to say, do I want to lever into that? Also, people still worry about real estate crashes and those sorts of things because of what happened in 2008. So you look out there and it's like, where do you really put your money, right? And so that's where the stock market emerges. And people look at stocks as not just, oh, I'm going to make money in this, but this is going to hold value much better than keeping money in a savings account, keeping money under my mattress, something like that, right? Like I think that's the way most people view it, right? And I mean, over time, you get your 8% or so a year in the S&P 500. If you own great stocks and great companies, you get a whole lot more than 8% per year on average, right?
I have to say, though, there's a lot of S&P 500 stocks trading at 10 times earnings, no matter what people's long-term retirement needs are. So I just wonder if it's about these huge businesses that are kind of winner take most, that got all the attention last year, that have 30 times multiples like a Microsoft and things like that, whereas it's leaving a lot of other stuff out there that at a different valuation range.
Well, we've begun to see a broadening in the rally, most certainly. And, yesterday and the day before, we saw a lot of what used to be, I think it used to be called garbage to gold. Yeah. You saw a lot of jumping of things that had underperformed. But within the other sectors, within value, growthier value, there's good opportunity, we feel, as many companies invest in technology to maintain a good premise for investors to invest in value companies by virtue of being able to maintain a good cash flow and profitability and revenue growth.
Do you think there's going to be some kind of a reckoning? We were talking earlier about what's implied in Fed expectations. And I guess you have to ask, is that plausible that rates get cut a significant amount by the end of the year? And do stocks need that to happen to perform?
We think in the first 2 days, there was a thought of, maybe that was wrong, looking for 4 to 6 cuts. Yeah. We haven't been part of that camp anyway. We think the Fed is likely to maintain the regime that it currently has, probably just pausing for longer. And with probably in the fourth quarter of this year, seeing a cut, 1 or 2 cuts, and then not for emergency purposes, but rather just realizing they're a heck of a lot closer to their 2% target.
Okay, so let me be very, very crystal clear about this. That gentleman and myself, I think we see much more eye to eye. I'm not so convinced. Everybody's thinking about March, the Fed's going to cut, and then they're going to cut again, the summer and this and that. And some people are even pricing it. I've seen some people pricing in 4 to 6 cuts this year. And I'm just like, I'm not convinced of that. Why is the Fed going to rush out there to cut that many times? I mean, maybe they could, but I'm just not convinced of it at all. Given that the economy is holding up very well, jobless claims are looking just fine, unemployment's holding there really steady, and still we don't have a CPI in the 2s. So I'm just like, I don't see the Fed cutting as aggressively as a lot of folks are cutting, are thinking, right? I think I'm a little more in that guy's camp about if they do cut, it's probably going to be in the back half of the year, toward the end of the year, something like that. Yeah, that's a potential. That's potential. But all this, they're going to cut like crazy in the spring and this and that. I'm just like, geez, man, people are running, I think, just to conclusions a little too quick here. Now is a good time to consider buying the dip in the Magnificent Seven. Let's get into this one.
CEO and CIO of Defiance ETFs. Is that right? Did I get that right, Sylvia?
Yes, you did. Good morning, Steve.
All right, good morning. So let's, I don't know how to start here, but the market has been very, very concerned that we haven't had this so-called Santa Claus rally, and all of a sudden the bottom is dropping out of this otherwise great rally we've had. How worried are you about the last 2 days of trading?
Well, I certainly don't love the last 2 days of trading, right? You want to go into the new year with the market rallying after what we saw towards the end of last year, but I'm not too worried about it. We saw that big run up from November until, pretty close to the end of the year. And I think that some investors actually did take a little bit of gains off towards the end of the year and maybe for tax reasons into the beginning of the first couple of days of this year. So it could be just a little bit of an overbought pause. I'm not reading too much into it. I don't think that much has changed in terms of the market from a week ago. And, the reason that we might see a market rally in 2024. So different rate environment. The Fed is no longer going to be hiking rates. Corporate earnings were strong. GDP held up. Consumer held up. It feels like we have that soft landing. So I expect this to be a pretty decent year for equities.
With the last 2 days of declines, are we still in an overbought situation, and how do you gauge that?
Yeah, I think it's hard to say whether that, kind of completely wiped out what we saw in terms of just positive sentiment and just, the market getting super excited about the talk of the Fed going into the end of the year about the potential rate cuts this year. So I think the answer is it's hard to say. I think that, a little bit of the froth came off the market, and I think it's a good time for investors who particularly are looking at the Mag 7 to consider buying on these dips. So whenever I see 1% to 2% pullbacks in some of these stocks that just have so much room to run for various reasons, and that is the Mag 7 in my opinion, I do like to kind of dollar cost average in and just hold it for the longer term and not worry so much about whether or not they move down another 0.5% or so before they rally back up another 10 to 15 before the end of the year.
So let's be very clear about buying the dip in these sorts of companies, right? In great companies, be very clear, every dip is a buy. Every dip is a buy in great companies. Everyone. And the bigger the dip you get, the more you need to say, thank you for this. That's the bottom line in regards to great companies. Every dip in NVIDIA the past 20 plus years has been a buying opportunity. Every dip in Amazon stock the past 20 plus years has been buying opportunity. Apple stock, Google, we can go down the list. Every dip. And the bigger dip you get, the more you need to be an aggressive buyer of those sorts of great quality companies that just have growth and growth and growth, right? And even if you want to take it into, we can even take it outside of tech. Every dip in Coca-Cola stock the past 50 years has been a buy. Every dip in Pepsi stock the past 50 years has been a buy. And Procter & Gamble and so on and so forth, right? Even for those old school companies, those value type companies, right? Even for those sorts of companies is true, right? Even, the Caterpillars of the world. It's incredible. So that's bottom line. When it comes to great companies, every dip's a buy. It's just as simple as that. It's literally as simple as that. And the bigger dip you get, the more you should be buying.
Seem to like some of these well-liked stocks, Google, Amazon, Microsoft. Tell me why you think these are still places where people ought to be putting their money.
Yeah, so I think, on a basic level, all of these stocks have strong balance sheets. I think they've sort of, withheld the rate environment in 2023. If we go back to 2022, these stocks were absolutely crushed. And I think that last year,
true statement.
The range of returns was anywhere from 25 to 250%. On the Mag 7 Plus, and the NASDAQ up about 40% or so for the end of the year. So I think it was a bit of a recovery year, and it was just sort of tapping into the opportunity of what is AI and kind of the creator environment. I think this year is going to be more about quantum computing, supercomputing, machine learning, data mining. I think it's going to be the enablers and the users of AI more than sort of the creators of AI. And so I think you still have a big runway in these stocks. They're the providers of things like the cloud, the quantum supercomputers that can actually make AI a reality. They're the providers of the technology that other companies are going to use to employ AI in their services, whether it's healthcare, factories, and things like this. So I do think that there's a tangible reason for them to run. And, I think some of the names like Google, you're looking at a 20 times forward multiple, a little bit lower than the market. Microsoft has a pretty low beta. And again, these are companies that are just quality companies. Some of them look like value stocks.
And also you like IBM as well, which I think is interesting because is it time to play quantum computing or is it still too early yet?
So I think we're just kind of dipping our toes into it, right? So you have what we talked about. I heard you talking about with Christina the chip spill this morning. Well, there's also several $1 billion going into quantum computing by the U.S. There's about $15 billion going in by China. So the investment is starting to go into that space. Companies like IBM are already sort of doing something with quantum computing and monetizing it. So, for example, they work with Cleveland Clinic on providing quantum technology to work with research on how proteins affect different cells and drug reactions and things like this. So they're already being used. You have companies like IonQ partnering with Amazon to provide utility quantum computers. So I think that you have the government, you have a lot of large corporations that are willing to dedicate 5 to 10% of their R&D into this space. So you're going to start seeing some of that money pour into quantum research, and once it's actually kind of employed and up and running, you get that growth there. So I do think that this is a 2024 to 2030 story, and I think it's the expansion of AI, right? If AI was the hot term of last year, this year it's going to be quantum and supercomputing.
Interesting. Yeah, no, very strong opinion about IBM. They've, I don't know the last time IBM was really the company that was a super executor. They're unfortunately just have had trouble the past 10, 20 years really growing that business. Let's just call it that. The last one up here, Josh Brown. Looking forward to getting into this
right
one.
Now as the Santa Claus rally ends and investors position for whatever a new year might bring. Let's ask Josh Brown, CEO and co-founder of Ritholtz Wealth Management. He is with me here at Post 9. All right, so 2 days of red in a row. I said we had some buying of mega caps. You got to believe at some point investors are going to look at declines in those stocks and say enough's enough. Enough is enough. The best stories in the market, and those are the best plays still.
So I agree, and we talked yesterday on the half about just like why are people selling? Obviously, nothing fundamentally changed. People have massive gains in these stocks, especially if they held them through the fourth quarter. And if they did that and they were waiting for an opportunity to take the profit, I'm on the wealth management side, so I already know the way financial advisors think, the way high net worth investors think is, all right, we're going to take 10% off the table, but why would we do it in this fiscal year and owe the taxes in April? Let's push that.
Hey, who's been talking about that for the longest time, man? That's exactly what I called out.
Let's push that tax liability a little bit further out without taking significant risk.
Exactly.
This first week of January, after a massive, very sector-specific rally in the market, makes perfect sense to see profit taking. I also think there's a lot of rebalance activity. You combine those two things on the scale of trillions of dollars. That's how you get these stocks start the year looking like they're stumbling, but really, fundamentally, their businesses are not stumbling.
Let's talk about this a little bit deeper, because Tony Pasquarello of Goldman Sachs, head of hedge fund client coverage on this program a lot, just sent a note out before we came on the air, and it plays right into that story and the question that all of you want answered, right? Because he's thinking the same thing all of us are.
Yeah.
Is mega cap tech a consensus position? Of course. Is that a problem? Not necessarily. Here's what he says, quote, a set of stocks that are very well owned and dearly valued. Okay? Now, I would argue these are the best balance sheets on planet Earth.
No,
they are generating and returning an immense amount of capital. They have the most direct leverage to the most attractive new theme. Where I come out, continuing to quote, these stocks are not cheap and they are widely held. So one should be a little choosy on adding length up here. Bigger picture, however, I'm inclined to keep my eye on the ball and would look to add on meaningful dips. Now, 1 day or a day and a half doesn't make a meaningful dip, obviously.
I'm with you.
However, the point is clear. These stocks went up the way they did for a reason, and they're going to remain in favor for a reason.
Look, I happen to think Alphabet and Amazon are two of the best stocks to own for this year. I don't love the valuation. Do I wish they were 10 turns cheaper on PE? Of course I do. But these are the cards in front of us, right? We don't always get to pick. I think these stocks will be very stable this year. I don't know that they'll outperform everything in the way that we saw big cap tech last year outperform everything. But I think they can work because they are two of the biggest beneficiaries of AI. This is the year that AI goes from a concept to an actual product. Microsoft's got an early lead, but I think when you look at the ownership of Anthropic, you look at Amazon now using their own chips to train large language models, you look at Alphabet's opportunity to incorporate these tools into all of their existing products for literally hundreds of millions of people on day one. These are companies that are going to benefit, and I don't think they're so expensive that we have to look past them on a valuation basis. So,
and beneficiaries include, in terms of some of these companies, Microsoft certainly, Amazon with AWS. I think Salesforce is going to benefit from this. I think companies like Palantir obviously are going to benefit from this. So there's many companies in many different spaces and of many different sizes that will benefit from AI, in my opinion. Even Snowflake in 2024.
It's not as great of a setup as it was last year. I still want to be there, but I want to be in other places too. And I think you don't have to choose. You can do both things at once. Energy got off to a great start this year. This is the third worst performing sector last year. This year it's in the lead. Food. XLE plus 3%. There's no reason why that couldn't continue, and actually crude caught a bid today. So there are other things to do. It's not Amazon or energy, in my view. It's Amazon and energy. I think you want to look all over the world, quite frankly. There's a lot of value elsewhere.
Interesting. Okay, guys, appreciate you joining me as always. Thanks so much for being here. Thank you for being subscribed to the channel. Also, if you're looking to apply, join my private group. If you're looking to join my Patreon, all that stuff, that'll be pinned comment. Also be in the description area down there. Much love as always, and have a great day.